Okay, so what is your view about this question? Is this very hard? Hello? Have you finished reading? Not too much, but it's long. Actually, it's not very long. So probably, so reading and understanding the case could be a challenge for some of you. Okay, so, but I still prefer you do the question by yourself, I think. Once you finish your reading and fundamental thinking, just let me know, okay? Okay, duty of care engagement letter. So the company KKM rely on the audit report to lend money to cheap, so proximity established, creating a duty of care. So are all of you ready? Okay. Yes? Cool. So in answering this question, actually, the first thing I want you to answer is yes or no, because question is, will KKM be able to recover its losses from Black? So first, you are going to answer the question directly. Yes, KKM will or KKM will not be able to recover the losses from Black, right? So yes or no is a very important answer. Okay, so yes. So KKM is able to recover losses from Black. Okay, so now why? It is because so actually Lin has already outlined the approach of thinking. So we can make it more structured, for example. So duty of care. So the audit engagement expressly satisfy KKM's made expressly to satisfy KKM's condition for making the loan. Therefore, the inducement or the proximity exists. Which created a duty of care for the third party. And actually, in this situation, you can also code the cases like Ascenda or Kapar if it's asked, right? Okay. So duty of care has been established. What is the second point?
Whether there was negligence.
Negligence, okay. So further you analyze negligence. So what has been what information has been given from the case regarding potential negligence?
Black was engaged to do an attestation review engagement of Cheap's financial report. Cheap has valued inventory at cost rather than current fair market value.
So
where cost is above fair market value.
So
and
the inventory valuation was not
incorrect because it should be valued at the lower of cost or
in accordance with the accounting standards, which requires lower of cost.
net realizable value.
Net realizable value. Are there any other potential negligence? Not discovering to creditors? Yes. So also Black was negligent in not discovering and disclosing the security interest of two other creditors, especially in the views of the fact surrounding the purpose of the engagement. Engagement is about the loan. So identify the security interest of the creditors will be a very important objective of this engagement then, right? So you got two arguments regarding the negligence. Then what is it? The next one. So privity, but actually privity has already been discussed in the first points, right? So you don't have to have that.
So damages would be the next point.
What is the one before the damages?
Causal relationship.
So causal relationship is also likely to be discussed. Causal relationship likely established course. Mhm. Why would we say actually there is a potential causal relationship here?
Because Black was engaged to do an audit of the financial report to because Cheap was seeking to induce KKM to for a loan, and also that KKM wanted obviously a secured position over all unsecured assets.
So actually, in terms of causal relationship, so as long as your discussion is reasonable, I think it could be acceptable. So here we say, okay, because the voluntary liquidation and the consequential loss is caused by the misreporting in Cheap that were neglected by Black. And then the final one will be damages, right? So the damage here is measurable, and the consequence of the negligence can also likely be established. So damage is measurable, and also the damage is an outcome of the negligence. So also linking to the causal relationship as well, right? So simple. So in this question, what are the key points? In this type of question, so what are the key points? We have 6 points to consider, right? We have 6 legal cases to cite. So I think that's a basic to answering this type of question. So for the legal liability question, is this okay? It is very important. So you need to give a very clear answer regarding yes or not. Yes or no, right? So question 3. Can we now go to question 3? Okay, so you could also discuss the potential contributor negligence. But in this case, I think it's not so relevant because it is about the third party issue, right? Let me add in. So here. Also, you could talk about contributory negligence if relevant to the case. Okay. Okay, now question 3. So suppose question 3 here is about audit risk, business risk, and engagement risk as this very simple case in part A. How would you develop your answer? Mhm. So I'm going to highlight the important keywords in the question. So here the question asks me to identify the business risk, right? And also explain the risk of material statement. And then identify key accounts. Also, key assertions. I think it's very, very fundamental risk analysis here. Okay, I give you 5 minutes to read the question and then write up your own answer. So once you're ready, also let me know in the chatting box or just shout. Mhm. Ready? Second ready? Do we have another ready? Okay, all right. So can you identify business risk from the case?
There'd be an overstatement of assets and also an overstatement of profit.
Overstated assets and overstated profits. Okay, so do you agree, Ling and also Kim? What is business risk? So that is a risk will have some impact, usually not very good impact on the business, right? On the business success, for example, on the operation, on financial management, on investment, etc. So it's not very specific to accounting. When you analyze the business risk, you need to analyze what is the impact of this risk on the business. So, so Anthony, when you say there is a potentially overstated assets, overstated profit, so actually in relation to the business risk, what was the underlying business problem here?
Well, ownership of the consignment means you own the produce on the shelf at the supermarket, and it's because it has a short life. It's likely to be thrown out, so which you wouldn't know about until probably down the track. So you could be overstating the inventory.
So it is because the supermarket are responsible for disposing the unsold stock. Therefore, there is a risk that staff could commit fraud by advising the stock was unsold and disposed. The fact is opposite. Is this what I mean? Anthony?
Yeah, there obviously is a fraud risk there, and there's a going concern risk.
So what do you mean the going concern risk here?
Because you could be disposing of so much product, which you've obviously had a cost for, which you're expecting to make a revenue. So obviously the sales are decreasing at such a rate, you just don't know what sales you're going to make. So you could quite quickly, I suppose, go out of business because you just don't know your current position.
So that is one identified business risk. So further, also Anthony mentioned, so there is a potential going concern issue. Okay. So also, Megan also mentioned, so actually staff could steal the unsold stock by saying those goods are unsold and has been disposed, etc., right? So we can see actually from this case, in terms of business risks, there might be multiple ones could be identified. So anyone could count, right? Because you are only asked to identify one business risk. And now, when you talk about risk of material misstatement, so Anthony, you can move on to the impact to the financial reporting.
Yeah, so there could be obviously an overstatement of inventory, which would be obviously an overstatement of assets, obviously an overstatement of net equity of the business.
I beg your pardon, overstatement
of inventory, which is obviously an asset, which obviously would mean that there'd be an overstatement of asset.
So all of you agree. So because of the fact, is this more likely understating the inventory or overstating the inventory? I think in this case, for the potential fraud, potential stealing activity is more likely understatement. Is that right?
I suppose I was looking at it from the produce is sitting on the shelf and is being thrown out. So your computer system would be saying this is the inventory level, but supermarkets are throwing it out. So you might be thinking that I've got this inventory, which I could still possibly sell, but actually I don't have that inventory because supermarkets have decided to throw it out.
Yeah, so once they claim it has been sold out, so it has been disposed, and then there will be an impairment of the inventory, I believe, right?
I suppose it's just how quickly that occurs.
Okay, so in your, because here we talk about the audit risk, so we talk about the risk of material statement in your end of year financial statement. So what is the impact of this business risk to the end of the year financial statement? Then it's very likely there will be understated sales, probably also if it's not. So actually accounts receivable might not be so relevant, right? But if there is a credit sale, it's still about accounts receivable. So understated sales, understated inventory. Because once it is being claimed as disposed, unsold and disposed, so those relevant stocks will be impaired, will be write off. That's right. Stock have been sold and the proceeds maybe have been illegally kept by the staff instead of reported on DGL, or stock still on hand or have been taken by staff illegally. So in the first case, that is understated sales. The second case, that is understated inventory, right?
But if it was stolen, like the inventory wouldn't exist. So if the theft is occurring, it's not as though your inventory is understated. If the supermarket was, let's say you had 1,000 items and they said, oh, we threw 500 out, whether the 500 got thrown out or got stolen, you still would only have 500 items.
Yeah, so actually, yeah, I agree with you. So those are three different situations. So stock still at hand, that means inventory has been understated, right? But if it has been taken by staff illegally, then this further link to the fraud risk. Is this better now? Okay.
I suppose it's just the information that's coming back from the supermarket, because if the information that's coming back from the supermarket, let's say they're saying we're throwing it out and they're stealing it, if they're saying that you only have 500 items there and you're putting that into the financial report, then there's no risk of material misstatement, because you're obviously writing down your inventory, and that obviously would go through as an expense, and writing down the asset.
So from the company's point of view, it's very likely. So the inventory has been understated in either cases. Is that right? So this inventory should be there, but has been but the amount has been understated due to not recorded, due to being claimed as being disposed. So either leading to the understated of inventory.
But I'm probably missing it, but I just don't know how it'd be understated, because if the supermarkets are giving feedback to say they've thrown out the inventory, so the inventory doesn't exist, and you put that into your computer system, which generates your financial reports, then you'd be stating the inventory at its right level. Obviously, your profitability has gone down because you're not selling, you're manufacturing product and not selling it. But yeah, like you wouldn't be misstating your financial statements. They'd be just reflecting low profitability.
Let's say, okay, so if there is a understatement of inventory and sales, of course, the subsequent results will be the understated profit, of course. Okay.
I would have thought that the scenario, like probably the business risk is on management, and management, the potential for management to fraudulently misrepresent the reports because of like a decision that's been made that's obviously causing lower sales, so that they might not be the information that's coming back from the supermarket regarding the throwing out of stock. They might not be recording that in their system. So that would be a more potential risk.
Yeah. I think you have been giving a very a more detailed explanation to the scenario, but I just want to simplify. So overall, so those effect will be about understated inventory or understated sales, both of them leading to the understated profit or understated assets. So it doesn't matter from which channel, but the overall consequence to the company is the understated profit and also understated assets, right? So in your explanation, I think, so if your explanation is reasonable, any direction will be fine. Does it make sense? I just provide one example because we are only asked to identify one business risk and then those associated audit risk.
Yeah, it makes sense.
Okay, so can we also further develop from this? What are the key accounts and key assertions?
The existence and the valuation of inventory.
Mm-hmm. So key accounts, inventory. So here, valuation. So if you can make it more accurate, that is accuracy, valuation, and allocation assertion, right? So of course, you will also have explanations. Okay. And explain the key assertions. So inventory, you say valuation. What are the other optional answer here? Okay, existence, completeness. So it might be subject to stating activity, so that is about existence. That is also about, so maybe it's still there, but not reported by the supermarket, so that's completeness, right? So for each of that should be fine, but you need to provide a proper explanation. What is the other account you could also identify? We say 3 key accounts. Can we say sales?
Occurrence, maybe?
So sales, so occurrence, why? So sales has occurred, but not recorded. Or the reported sales from the supermarket to you hasn't occurred. So like, okay, course, reported sales not occurred. Or sales occurred but not recorded. Which one is more relevant?
The second one?
Second one. Okay. So here, actually, the second one is more reasonable, right? Because in this case, I think for each of the possible situation is very likely. So there is a sale, but not reported back to you. So what is the assertion? If there is a sale occurred but not recorded, what is the assertion?
Completeness.
So that should be completeness. Okay. So, okay. What could be the other count relevant? So there is a sales in the market, but not reported, not completed, recorded. Then once there is a sales, so from the supermarket to you, that is accounts receivable, is that right? So still accounts receivable and also about completeness assertion. Okay, does it make sense? So if occurred sales not fully recorded, so those associated accounts receivable will also not be fully recorded. Does it make sense?
Yes.
Okay. So here in this question, what we want to emphasize is, so please read the question carefully. So here you just need to provide one identified business risk. So if you could identify more than one, pick the one may be easy for you to get to write down the answer. Also explain the risk of material misstatement. You need to understand the difference between business risk and risk of material misstatements. And also here, don't forget, they also ask you key accounts, key assertion, etc. Right? Don't forget any key points in the question. Okay, part B. This is a very short case, so it should be very easy. So from this case, what is the impact on audit risk, and also what components of the audit risk will be affected? So this company is Curtains and Blend. So market is highly competitive, experiencing decline in the sales for 3 years. And also very hard to do any cost saving. The bank has continued to provide with loan facilities now indicate unless it could see improved results. And also there are very quite restricted debt covenant in the loan agreement. Also, recent articles seems to see the financial results are not good. So as Megan provided, that it seems a going concern problem. So that is going concern risk, right? Kim also suggests overstated sales. Any other suggestions? And overstated sales and also inventory valuations. Okay. One more suggestion. No, okay. So we got enough actually. So what is the justification for the going concern risk? So declined sales, falling sales margin, profit margin. The bank's strict covenant and also expectation to see improvement. And also so very bad expected financial results this year. And also declined performance for 3 years plus. So it seems all the information can tell us the company has experiencing very difficult time and is struggling for survival. Okay. So I think, so these identified reasons are quite valid. Okay. And Kim and also Ansley also mentioned the potentially overstated sales or inventory valuations. So you also need to provide a justification. So I guess you want to link actually to the pressure to the management in boosting the performance, reported performance. So therefore they have the incentive to overstate the sales, overstate inventory valuation, etc. Is this what you want to say?
Yes.
Okay. Now you've got something here. So suppose you are able to put both of them in the answer. Okay, I think it's fine. If here is just discuss one impact on the audit risk, which one you want to put in.
Probably the going concern, as it's the more serious one.
Yeah, because actually the second one is the financial consequence of the first going concern one, I guess, right? So if you can only provide one, you will choose going concern, but in this question, it's okay if you choose both. Then, specific components of audit risk affected. So it seems actually overstated sales, overstated inventory seems to be more relevant on part B, is that right?
Yes.
Okay, so how would you develop your answer on part B? What specific components of audit risk will be affected? What are the components of audit risk? So for the components of audit risk, we know that includes inherent risk, control risk, and detection risk, etc. Right? So so your further analysis will be relevant to those, will be analyzed around those three components. So for example, increased pervasive inherent risk at the financial report level. So you could do a further explanation. So from that, you could further explain. I couldn't really control this. What happened? Okay, so you could do a further explanation. So increasing pressure. So overall, incentive to boost the profit in, right? Of course, you can make it more specific. For example, in particular, probably also increased inherent risk on sales. You could also see actually it's because of pressure. So sales could be overstated. With your own words. Also increased inherent risk on inventory. It could also be about other accounts, right? On inventory, on accounts receivable, on provision, on expenses. You could have multiple answers here, but on any one of that, you do need to provide reasonable explanation. Okay? So this one is easy. So in answer this question, so the impact is important. When you mention impact, you would indicate what is the impact here. And if we say components, you need to break it down to the components of the audit risk model. Okay? Part 3. I could say actually questions are very, very simple. So here in this revision, what I want to do is to let you know how to answer those questions. Okay, so once you are able to explain to analyze, probably in your answer, you'll be some very key explanations. So if you know how to answer the questions, you can get more marks, I guess. Part 3. Identify 2 key fraud risk factors. So this is a very simple one. Let's just do this one in 2 minutes. Are you still happy to follow?
Yes.
Okay, yeah. I know it's quite tired. It's because if you're asked to do the question by yourself, it's very much like the real exam. Okay, so the question asks you to identify 2 key fraud risk factors. So you don't need to provide more than 2. So what you need is identify the fraud risk factor and then provide some explanation. Okay, so one is
So you'd have fraudulent financial statements and misappropriation of assets with the other one.
okay. So one is misappropriation of assets, and then the other one is a potential fraudulent financial reporting. Okay, but it has been too general. So you need to know what are the fraud risk factors behind the potential misstatement and also the fraudulent financial reporting. Okay, so before you go to answer the question, let's do some revision. So you have 2 types of fraud, that is MA and fraudulent financial reporting. And when we consider the factors, the fraud factors, so there will be a fraud triangle for you to consider the fraud factors. So the factors will be the facts you extracted from the case that could be linked to something in the triangle.
So there'd be pressure on management to hit its sales targets.
Mm-hmm. So the management remuneration package, link to sales. So you can see that this one would be pressure or actually incentive. To manipulate sales. So actually this one is not about misappropriation of assets, it's more about fraudulent financial reporting, I guess, right?
Yep. And the other one, which would be the misappropriation, would be associated to the staff and the financial processing functions not getting training. So
okay. Lack of training accounting stuff. So that could be linked to misappropriation of assets. So actually in this question, I think the factor and explanation should come together. Okay, so in your answer, I don't really mind. As long as your explanation is there, I don't mind if you put in this box or in other box. However, so the risk factor should be identified, and also you should have explanation somewhere in this question. Okay. I don't know. Okay. All right, so this is actually very easy, right? All right, so in the question 3, what I really want you to pay more attention to. Are you understanding business risk? For example, when you do the business risk question, some of you answer questions from the audit risk perspective, right? So please differentiate what is business risk and also what is audit risk. So what is audit risk and also what are the audit risk components? What is fraud risk? What are the types? What is a triangle? How would you analyze those fraud risk factors? Also, the other keywords is risk of material misstatements. Is this the same as audit risk or not? So if we talk about risk of material misstatement, you only have inherent risk and control risk to consider. When you talk about audit risk components, you will have inherent risk, control risk, and also sometimes you may also think about detection risk. Okay? Does it make sense? So the most important thing is you need to be able to apply your understanding of those concepts into case analysis. Okay. So analytical procedure 5.26, which is one of the tutorial questions. So I don't really want to go to details of this question because you have already done this in your assignment as well. So here for this question, I just want to give you some tips of answer this type of question. What is the requirement here? Okay. Can you just spend 1 minute to read this question? Okay, the question is, provide a brief explanation of the ratio and outline the conclusion you can draw, that can be drawn from those above ratios. And also identify potential audit risks to be further investigated. So for example, on any ratio, how would you explain that ratio? To explain, so equation should be presented and also explain the financial impact and auditing implication of the ratio. Okay. So for example, for the first one, current ratio is current assets on current liability. So that is equation. So what is the implication of this equation? So from financial aspects, you could say, okay, this ratio indicates the net working capital position. So for non-industry specific criteria, usually the benchmark could be 2, but this ratio could be different on different industries. It indicates the company's ability to meet the current obligations, etc., right? And then if we just use the first one as example, you can see so when you analyze, so you could compare to the benchmark to last year. So compared to last year, current ratio has declined. You could also compare to the benchmark. So I think that is compared to the industry. So the ratio of this company is lower than the industry as well, right? And then you can make a conclusion. And actually, so before compared to the benchmark last year, etc., you should also explain. So by itself, is this ratio good enough or not? Right. So for example, in this company 2.15, which is above the criteria 2, so it looks good. So then you make a conclusion. So it is above the benchmark of 2, but lower than industry and also the downward trend. So for what is the implication for the auditor? So auditor need to monitor to identify why there is a deteriorating current ratio, identify the reason by inquiring the management, and also to pay attention to review the current and projected cash flow for the potential liquidity issues. Okay. So that is an example. Okay, come back again. So for the ratio, explain the ratio. What is the ratio? What is the impact of this? What is the implication of this ratio? In terms of audit risk and also your conclusion, you analyze the ratio itself, compare to the do the yearly comparison, compare to the benchmark, then make a conclusion. And further from the conclusion on the financial aspects, further you need to extend to the implication to the audit risk, implication to the auditors. What should the auditors do? Watch out liquidation issue, ask the management for the reason of the deteriorating ratio, right? Maybe pay more attention to inventory, to accounts receivable, etc., etc. Okay. So this one I think should be handy for you for now. Of course, you have done a lot of practice in your assignment. Okay, so now it's 8:10. So let's take a 5 minutes break and then we come back. If you are still interested in the remaining part, I can still go through the remaining questions, but maybe we need to do that quicker. Okay. So I'm going to leave for a while and then coming back.